Hey, Steve Saretsky here. As always, a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Want to discuss this week some thoughts on sort of the economy, central banking as usual, and just a tiny bit on real estate because I don't want to get obviously micro focus pinpointed on sort of one topic. But I will say that I think it's pretty obvious what's happening in financial markets in general is basically this reflation trade, that there's sort of calm back in the markets. Central banks have sort of eased worries or concerns that we are going to plummet into an immediate recession. And what we've seen is, not only the stock market ripping to all-time highs, you see the VIX, which is basically the volatility index, plummeting as basically people take more and more risks. And we're seeing that, we can see that in Australia property markets. We can see that in a pickup in U.S. housing activity. And we see that here in Vancouver, which is basically this reflation trade. All these reports and realtors now are talking about, how great things are and things are moving along. And this really just goes to show how interconnected the global financial system has become, and really the dependency on central banks. So I actually look at that and say where we are today, even though people won't like it, and I'm gonna see all these angry comments in here, I wouldn't be surprised to see Vancouver prices, at least in the affordable segments, i.e. sub 1 million, begin to rise and potentially even accelerate into the early parts of 2020. Big reason for that, again, is not only because you have this reflation trade, but if you want to look on a more micro level, here's the months of inventory for Vancouver condos. Currently sits below 4, so you have 3 months of inventory for sale, which generally suggests anything below 4 months puts upwards pressure on prices, and that's what I'm seeing from a feet on the ground perspective, is a lot of multiple offers, things that are selling quickly for affordable product. Now, where you see the weakness and still you're seeing downside pressure on prices is the high-end luxury market. And this is not just a Vancouver thing. This is literally happening in property markets across the world. Is basically the luxury bid has completely pulled back. A lot of that has to do essentially with the Chinese bid, Chinese capital flight repatriating. The Chinese, again, are actually net sellers of global financial assets in 2019. That's the first time in over a decade. And so you can see this luxury property market pulling back. And again, Vancouver does not work in this vacuum. There's basically the global financial system's interconnectedness of that. So again, you can opt to play into that reflation trade, or you can opt to sit back and look at alternative investments. And that's certainly, it's interesting. Having some conversations with a lot of my, friends that I'm close to in the finance space, some of them I would argue probably much smarter than myself, that are just kind of left scratching their heads like, yeah, this kind of just keeps going on. And maybe people that are even bearish on the real estate side of things just saying, yeah, it's definitely moving. He's like, but that doesn't mean I want to plan it. He's like, doesn't mean that I can make the numbers work and make it work for my situation. And that's, kind of, it ultimately is an independent decision on what are your objectives, what is your investment thesis, and how does that play into everything? So, to give you an example, we still have these things. He's like, I can't really make sense of it. We have the Canadian yield curve. It's actually the only yield curve that is still inverted today across the world. So we had yield curves almost globally all plunging into inversion. A lot of them have recently come out of that due to that sort of reflationary trade. And now the Canadian yield curve is the only yield curve which still remains inverted today. The Bank of Canada is still on hold. as the Canadian dollar is the strongest performing currency year to date in 2019. Anybody, had you asked them 18 or 24 months ago, probably would have told you that the chances, including myself, the chances of that happening, the probability of that would be probably close to 1%. But lo and behold, here we are today. So just kind of goes to show you how fascinating and intricate financial markets are, and trying to honestly predict those is next to impossible. But I just sort of sit here as a spectator, really just every day sort of amused by what's happening in there. I mean, we're all talking about this, global this real estate correction that's happened in Canada. It has now come and passed. It's over. Nothing to worry about. Move on. CIBC's Benjamin Tal put out a report just this past week saying, yep, it's all clear. What can we learn from that correction? And then, he put up this chart here basically showing that, despite the supposed correction in the national housing market, which only saw the home price index dip into negative territory for about 5 months, the share of the total labor force in Canada never dropped. Now, obviously, employment is a lagging indicator. You don't lay people off at the first sign of weakness. Typically speaking, you try to hold on to people. But what we saw is that basically the correction, if you want to even call it that, was so short-lived, at least from a national perspective. We know that Vancouver, parts of the housing market have been, severely depressed here for the last 2.5, 3 years. But from a national perspective, this sort of built-up credit, housing-fueled mania that we've had bull market building over the last 20 years, all the capital and labor that has been deployed into that segment never really left. So the employment rate, the percentage of the labor force still hovers around 10%. It never actually declined. So, typically speaking, in a recession, which our recessions are normal, self-fulfilling mechanisms that are ultimately used to cleanse and sort of repair excesses in the system. And so basically suppressing them, you actually make things worse. So this excess in the Canadian sort of housing environment and in the Canadian economy is never actually cleared. So you didn't have a large layoff in realtors. You didn't have a bunch of contractors, builders going bust. You didn't have a decline in the share of mortgage brokers. It's remained steady at nearly 10% of the Canadian workforce. So, i.e., not like if you were to look at, say, the oil and gas sector, which has clearly been in a recession, where you're starting to see the number of people not only leaving that industry, but the number of people coming up are opting not to enter that industry. That's the sign of basically a true recession, which ultimately sort of, they are painful, but they do curb excesses. So what's happening is we basically have a lot of capital and resources, i.e., not only financial capital, but human capital, funneling into real estate because it is really the only ways to sort of make a living or to make money, or why would you invest or create a business, whether that's a retail business or a services-based business, is you can just take the excess capital that you may have and just invest it in, say, a pre-sale condo, and it goes up by 10 or 15% a year. Obviously, that makes your economy basically less productive over time because you're not producing anything. You're basically just investing in a non-productive asset, which is real estate. So I just find that fascinating to see that, if we're clearly going to say that this, we've hit bottom and the recovery is on from here. Again, I'm not saying, I actually think there's a strong probability we will see an acceleration in home prices, given the reflationary trade, given that the Bank of Canada is likely to cut interest rates. But if we do see that, then we've never actually had that purge, which ultimately makes us healthier in the long run. But I will say this whole reflationary trade is predicated on the Canadian economy not bumping into, not stumbling and falling into a recession, which is obviously what the 2-10 yield curve is suggesting. So I think that's kind of where we stand today. I'm looking at it and saying, assuming the conditions stay the same, clearly you can see where the months of inventory is, where interest rates are, where the employment rate is, that there will be or should be an acceleration in prices for large parts of the country. But on the flip side, I think that you are still edging and teetering ever so closely to that edge and that abyss of that recession that, again, has been pushed back now 10 years from really central bank policy. And again, just this sort of easy money environment. There's a really good article in Bloomberg this past week, which basically notes that there's been a significant correction and decline in prices for Manhattan condo prices. People thought would maybe be inevitable, but again, all housing markets do succumb to gravity over time. So Manhattan condo prices have been declining, and they've basically been actually overbuilding there. So developers have been overbuilding new supply. And normally what would happen is if developers sit on... if you sit on inventory for too long, obviously eventually your next reaction is to essentially cut the prices. So, but what they're not doing is they're actually taking inventory loans, which are basically loans made against the existing inventory of the developer. It allows them to prolong, it allows them to resist from cutting their prices lower. It allows them to basically hold on and wait for the market to basically recover, and so then they can get the price that they want. So they're taking on these loans, and the only reason why these loans are available is because there's overabundance of cheap credit, and in a normal cycle, the central banks would essentially raise interest rates and put an end to the cycle. But what they seem determined to do is keep this thing going, print as much money as necessary to prolong this, but all you're doing is creating obviously more excesses, more asset inflation, and ultimately more wealth inequality and a widening of this social and political friction. So again, this is happening in large parts of the globe. We can see this in the Canadian housing market, just the amount of excess in terms of private lending money that is out there. There's so much money available that if you can't get approved at one of the big banks, one of these alternative lenders, Mix, will basically step in and fill that void, and that space is becoming so competitive because there's so much money that basically these guys are now actively and aggressively slashing their borrowing rates in order to gain market share. So they're making riskier loans and willing to take smaller profits because they need to deploy this capital. There is so much credit. So I just find that continue to be, I think that central banks are pushing this way too far. But this is the environment that we live in today. So obviously actively watching this with enthusiasm every week. So anyways, hope that helped. Otherwise, see you next week.